commercial real estate market, CREs, in 2024 is facing a looming financial crisis that could bypass the challenges experienced during the 2008 financial recession. This is apparent by the number of recent loan defaults by prominent landlords and a decline in demand for office spaces. Additionally, there are significant numbers of commercial mortgages due for refinancing in the near future. U.S. banks over the next 2 years will see more than $1 trillion in commercial real estate loans coming due. The expected damage could worsen into a full-blown financial crisis if hundreds of small and mid-sized commercial banks fail simultaneously. Currently, with the Federal Reserve keeping interest rates elevated, commercial real estate risks are worsening with falling property values. The commercial real estate sector encompasses a wide range of assets, including office buildings, shopping centers, apartments, hotels, and data centers. Morgan Stanley has issued a warning regarding CRE lending rates. Even if interest rates remain stable, new lending rates for commercial real estate are expected to be considerably higher than existing mortgage rates. This may allow an estimated 190 banks to face challenges similar to those experienced by Silicon Valley Bank, which closed earlier this year. Small to medium-sized banks, which make up a substantial portion of CRE lending, are especially vulnerable in this situation. During the COVID-19 worldwide pandemic, the rise of remote work led to a decrease in demand for office spaces, which has worsened because of escalation, maintenance costs, and interest rates. Morgan Stanley analysts say there is a potential for a decline in commercial property prices by up to 40%, which would rival the 2008 financial crisis. Many are asking, how did this commercial real estate crisis arrive here? Since the pandemic, banks have been overexposed and several long-held economic assumptions have been shattered. This includes perpetually subdued inflation, low interest rates, and a return to more in-office work. Making the situation worse are commercial real estate management costs, such things as insurance costs, labor, and energy prices, which have skyrocketed. An aging U.S. population is fueling worker shortages, forcing wages higher for some as firms aim to attract and retain talent. What's more, big city crime and natural disasters have increased property insurance premiums, and outdated electricity grids have raised building energy costs. As CRE property values fall and the debt service on associated loans grow, borrowers are becoming delinquent or defaulting. The portion of these loans that are non-performing more than doubled in 2024 from 0.54% to 1.25%. Unlike housing, where loans often are for 30 years, CRE loans normally have shorter maturities of 10 years or less. They also need to be entirely refinanced when they come due. Many commercial loans were made during the recent time of historically low interest rates. That's created a two-pronged problem. The persistence of working from home has driven fallen asset values due to declining demand for office space, and the building owners having significantly higher interest rates when refinancing. Commercial Edge monitors CRE rent demands and prices for office space nationally, and it recently found 2024 average office rents fell 1.2% year over year. That's not an actual terrible number, but when coupled with falling asset values for office properties with less demand and facing higher interest rates, it isn't a rosy picture. Commercial Edge also found sales on office buildings has resulted in more prevalent discounted office sales. Of course, there are sharp regional variations. Boston's commercial rents have shot up by 21.5% year over year. Rates in Chicago and Seattle fell by more than 2%. This reflects vacancy rates. Boston's rate is 12.2% compared to the national rate of 17.9%. So there will be major opportunities for buyers to snap up buildings at highly discounted prices. But there just may be too much office space to absorb, especially if banks are reluctant to lend. While the commercial real estate market is facing challenges, a full-blown crash in 2024 or 25 is not guaranteed. The market's resilience and strong credit performance may allow the crisis to be contained. Stakeholders, banks, real estate firms, and policymakers will have to consider innovative solutions too. This includes office to residential conversions to mitigate risks and ensure improved long-term CRE market stability. This is H.A. Gray.